in amongst the carnage there's some opportunities, there's some businesses that are under serious threat, but there's also some companies that I think are very, very low risk.
Steve Johnson, welcome to the business.
Great to be here.
You're an active manager, you pick stocks. How have you approached the conflict in the Middle East?
We haven't made a lot of dramatic changes to our portfolio, but we have been putting money incrementally to work over the past 3 to 4 weeks. That's not with any view about when or how the war is going to end, but in our little small cap part of the market, this sell-off has been really, really extreme, and some of the businesses in there are down 40 and 50% over the past 4 and 5 months, and for us that's a really good reason to put some of the cash that we were holding to work.
So when you're looking at that small cap end of the market, what particular sectors are the ones that you're going to put cash to work in?
I'd say outside of commodities, it has been extremely correlated. We own companies from a smash repairs company, a motorcycle dealership, through to some rapidly growing tech companies, and they're all down the same sort of magnitude. So that's why I say it's been correlated, and we've been putting money to work across that spectrum. New investments into the tech sector where we didn't have a lot of exposure, and then just incremental investments into some of these industrial companies that have got down to earnings multiples of 5 or 6 times, which is maybe a third of where the large cap market is at.
So you're seeing this is an opportunity?
Yeah, absolutely. I'm not jumping up and down about it being the greatest opportunity ever, but stocks, and again, particularly in our world, are a lot cheaper than they were 3 or 4 months ago. And I think you are going to have events like this over any reasonable time horizon. So when we think about what is the value of these companies, okay, they're going to be listed for a long time, they're going to generate profits for a long time, you're going to have a bad year in there. It doesn't change the value of these companies that dramatically, an event like this, and you get to buy them at 30 and 40% cheaper than you were just a few months ago.
The Australian market is very heavily weighted by commodities and energy. It's doing fairly well in the face of this sort of global energy shock as a result of that.
Yeah, I think people are looking at the overall market and saying it's not down that much. I don't understand this. There's a war going on. There's oil prices and petrol prices very high. And I think the market is seeing that impact on the consumer. So any company that is dependent on consumer sentiment here in Australia has seen its share price sell off a lot. But we actually have quite a few companies that are benefiting from higher energy prices, coal stocks, oil stocks, the big commodities players, and generally our larger companies as well have the capacity to pass on prices to their consumers and are quite defensive, supermarkets, healthcare businesses. So the index is not the economy, and it's held up better because we have some beneficiaries of this environment listed here in Australia.
Ahead of this war that is occurring in the Middle East currently, the tech sector was the big story. Has that continued to play out under the cover of the Middle East conflict?
I would say quite interestingly, it's come back to the fore this week as people have started thinking maybe this war is going to end. What do I need to worry about next? We've seen this SaaSpocalypse concept come back, and we've had a few new models come out from Anthropic and Meta this week, have both released new models that are apparently many times better than the ones before them. So that concern has come back. Atlassian was down 8% last night, its share price, after being down the day before. Again, that company's share price is already down 70% from its peak. So we've seen those concerns come back for sure, and they'd actually done pretty well through the war concerns because most of these companies get monthly subscription fees from their clients, and people started going, maybe that's not too bad relative to having to deal with oil prices and things. But the concerns are back. My personal view is in amongst the carnage there's some opportunities, there's some businesses that are under serious threat, but there's also some companies that I think are very, very low risk of displacement from AI, and you're getting to buy them at cheap prices.
What are those companies?
I think some examples are all of the accounting software players. So we own a UK company called Sage, for example. That's a recent investment in our portfolio. We use Xero in our business. That company hasn't got cheap enough for me yet, but we are not leaving it. We pay them $1,600 a year, so the cost is very low. They're very important to our business, and we are just not going to go and vibe code our own software. So I think that survives really well. And then there's a little ASX listed company called Catapult. We had owned this for many years, sold it last year because it got too expensive. It has halved over the past 6 months. I think there's plenty of examples out there of companies that don't face significant threats, and they've all been treated the same.
How do you see AI playing out in the economy more broadly? Are you concerned?
I'm actually quite excited about it. I think it's good for productivity, and as the world faces a declining population, we are going to need to get more productive if we want to maintain our standard of life. And we have been through 300 years of dramatic technological improvement, and people have freaked out every time it's happened about the loss of jobs, and generally it has been good for humanity for this to happen, and I think this is going to be the same. I think it's really important that companies and investors embrace it. If you're not, you're going to get outcompeted by someone that is. But I think there's plenty of opportunity for companies to take cost out of their business, to get more efficient, and to provide more services to people who need it. A really good example I use is financial planning. I would say 80% of Australia's population that actually needs financial advice can't afford to pay for it. Now, if you want good financial advice at the moment, it's at least $5,000, and if you've only got $50,000 to invest, it doesn't make sense for you to go and get that advice. I think in a world of AI, a financial planner that could service 100 clients and needed to charge them $5,000 each, they should be able to do 1,000 clients now, and maybe it's $500. And there's all of this demand that can be created with the technology. So I'm excited about it, and I think there's some really good investment opportunities being created by the negative sentiment about the technology out there as well.
When we think about diversification, is the technology now more interconnected with the physical world because we need energy, the electrification, the minerals out of the ground to create the various components? Is it harder to diversify?
Yeah, I think the idea of technology, we talked about the physical world and the non-physical world. This AI revolution is a very asset-intensive revolution, and it's going to require enormous amounts of investment. So I think those things had trended apart over the past 20 years, and now they're coming rapidly back together, and we have already seen dramatic cost increases in that space because there's just not enough supply to build what needs to be built in the near term. We've had a couple of companies in our international fund that have been big beneficiaries of that. Their profit margins have gone up a lot because there's just not enough supply. But I think that's absolutely true, that the connection is going to be stronger here between the physical world and the online world. And I think really importantly for investors, these companies are not going to be the asset-light software companies that we've had and benefited from over the past 10 years. That was a really, really great business model where you didn't need to own any assets and you got to collect revenue from your customers every month. It's quite different, and it's going back to the way we invested for a long time. You've got to look at a company's balance sheet and its profit statement. It's not just how much profit do you make, but how much assets does it take to generate that profit.
Going back to the current environment, volatility is pretty low on the market. What's that signifying?
Well, again, I think it's lower at the surface, and underneath the surface there is a lot of volatility within certain sectors, and particularly at the small cap end of the market. So I would say that the headline low volatility is more reflective of the nature of our market composition than it is of investor fear about what's happening. So almost every day when the coal stocks are up, the tech stocks are down because people see those factors offsetting each other. So at an index level, you're seeing very low volatility. At a sector level, it's quite high. And even in our own fund, it has not been uncommon this week for us to be up 3% one day and down 2% the next. And that's reflective of what we're seeing at the smaller end of the market.
And how much of a factor do you think passive money is in that headline or index volatility level being relatively low?
Look, I think it's a correlation, but it's not an explanation. And I actually don't think this dynamic is wildly different from what it used to be. A lot of the active funds management industry, which I'm in, is very critical of passive. But the reality is 20 years ago, the large active funds behaved very much like passive funds, right? They hugged the index. They had the same percentage in BHP as the index. So It was a passive fund that you were paying active fees for, and when people got fearful, they took money out of those funds, and that fund sold every stock that was in the portfolio. So yes, it's correlated, and yes, I think there's opportunities. Like I said, in software, when people sell the software fund, it's not which company's going to suffer and which company's going to benefit from this. It's sell every stock. But I do think that's largely the same as it was. It's maybe more amplified, but it's not dramatically different.
Investors are watching and waiting to see whether this ceasefire is going to last the 2 weeks and beyond. What are you watching?
Well, I'm watching the same thing, but I don't think I've got an edge in predicting whether it's more likely or less likely. And I think that's really important for investors to think about. You don't get to sit here and wait until this is all over and then still buy cheap stocks after the fact. The market is responding to things in real time. It changes instantaneously. And I think we got a little sniff of that this week, that, okay, this war might be over and the market's up 2.5% straight away. Once it's done and dusted and we all know about it, then the market is going to be up meaningfully more than that. So you don't get that certainty and get cheap stock prices at the same time.
Steve Johnson, thank you so much.
Thanks for having me.